Say that you are a math prodigy and you get in the best of colleges to learn and explore the world of math, and you get a PhD too. With this, you're going to be roaming around as a certified genius, but just imagine that just when you are out of the college, you get recruited by the NSA to help them break codes during the war, and you go on to play a significant role in it. That's life. Now again, let's say that you played your role at the NSA and this maybe wasn't enough challenging for you, and so you started a hedge fund and soon started managing billions of dollars. But wait, billionaire hedge fund manager? How did you go from being a math prodigy to helping your country in the war to reaching the top of finance all in one lifetime? Well, you and I might not have achieved all of this in our lives yet, but there is someone who has, and I'm going to tell you about this person in this episode of the Legendary Trader series, and you should really stick till the end as it's going to be very interesting. Plus, I'm going to share away 3 most important lessons this guy, the Legendary Trader, gave away in many interviews. So make sure you stick all the way to the end. This Legendary Trader is none other than Jim Simmons. And this is how his life unfolds that led to the pinnacle of finance and all his other achievements. Born in 1938 in Massachusetts, to a Jewish family, Jim discovered his love for mathematics from a very early age. Jim enrolled at MIT and graduated with a degree in mathematics in 1958. He then got into University of California, Berkeley, where he got his PhD in mathematics in 1961. He was just 23 years old at that time, which is an achievement.
To come here, I lived in the area and I wanted to come here and study mathematics when I was a kid.
Jim was done with his PhD in 1964 and was approached by the NSA. He worked there till 1968 and played a significant role in breaking code during the Vietnam War. After this, he went on to teach mathematics at the Harvard University as well as his alma mater, MIT. Jim then was appointed the chairman of the math department at the Stony Brook University, where he was successful in creating a world-class math department by recruiting the best of minds. We can pretty much say that Jim's academic career was going on great. He had won several awards for his contribution in the field of mathematics, but still, this wasn't enough for him. Jim wanted to do something different, something that none of peers even thought of doing at that time. He wanted to get into finance and apply his math skills in financial markets. He did actually leave his academic career and started a firm named Monometrics. Jim traded all sorts of strategies at the firm, but it wasn't doing too good, and that's when Jim decided that things need to be fine-tuned a little. And he set up a firm that went on to redefine the entire finance industry. In 1982, Rentec was founded, and in this fund, Jim had decided that only quantitative strategies were going to be used to generate alpha. At that time, Rentec was becoming a talk of the town for a completely different reason, and that was because Jim was only bringing people from the non-finance background on board. He built a team of mathematicians, cryptographers, physicians, and all sorts of people from academics, and they started building trading models. During his time at the NSA, Jim realized that people can be taught the work, but they can't be taught how to be smart. So at his firm, he hired the best of minds, and they all got down to applying their math knowledge and looking for ways to capitalize in the market. And now, did all of this pay off? Of course it did. And it paid off big time. It is reported that the fund now manages over 150 billion US dollars and has returned around 70% in profit year on year. That is 70% of profit each year. And Jim himself is also worth around 23 billion US dollars. You might ask, what strategies did Jim trade and generate such massive returns? Well, I'm not a quant expert, and the strategies that Jim used at his firm is so complex for quant that even some of the top minds in the field had a hard time understanding these methods. The firm has kept their strategies a bit secret, but it is said that the strategies look to find patterns in the market and capitalize on them. Now, most strategies were based around mean regression and statistical arbitrage. Now, what is mean regression? Here's a clip to make you understand it.
Regression to the mean? No, it's a bit of a technical way of saying that things will always even out.
Like things will always get better.
More like things can't always be bad.
So no matter how bad things get,
Or how good.
they always come back to the middle.
Regression to the mean.
So, technically, in a mean regression strategy, the traders would look for the price to go above or below fair price and would trade accordingly. So the price always has a fair value, and from time to time it will move away from it due to unforeseen events like coronavirus, results, etc. Things like these happens a lot, and quant traders like Jim and company try to capitalize on this very thing. A statistical arbitrage strategy would trade two or more instruments together. A price relationship would be derived and trades were taken accordingly. Now, say that you fetch historical data of BTC and Ethereum and find a relation between their prices. Each time there is an unforeseen event like that of China banning cryptos, the prices of these two will move and will disturb the relationship. This is where quants can get it. Sell one and buy the other and look to capitalize on the price arbitrage that has arisen between the two. When Jim started the fund, he would try and fetch the market from everywhere possible and would compile it and look for patterns. And these were obviously patterns that we don't understand, but was more like mathematical patterns, and they would use this to capitalize on the market. The approach that Jim's firm had toward trading, they were winning only 50% of the times. And still, they were able to make billions. How is that possible? This was possible only because the winners were so big that it covered all their losses and gave big profits too. At that time, no one was doing what Jim was doing, and hence he got the results. Eventually, a lot of people noticed Jim's work and lots of firms started getting into quant trading. So, it won't be wrong to say that Jim pioneered quant trading. This was pretty much how Jim rose to the level of being the quant king and becoming one of the best and the most successful hedge fund manager of all time. In 2020, Jim retired from Rentec but would still remain as the firm's non-executive chairman. Apart from his professional life, Jim has been active in his philanthropic endeavors, and it is reported that Jim has given away around $3 billion for various causes. He has even been actively donating to political campaigns. Jim is one of those billionaires that avoid the media, and he is someone who likes to live his life away from the spotlight. I personally found Jim's life pretty interesting and motivational, and I could take back 3 key lessons that I learned from his life story and also from some of the interviews he gave. And before I give it to you, before I show you all the 3 lessons, if you are new to this channel, then make sure you subscribe to it, and if you are enjoying this video, then make sure you smash that like button.
I'd walk in one day, everything was going my way. Oh, I'm a genius. The next day I'd walk in, everything was against me. Oh, I'm a dope. It was a very stomach-wrenching business. Whereas with a system that you can develop, okay, you have a system. You do what the computer says to do. You have made a historical study of the system that you're using, and it worked with a very high probability the system was going to work. And so I was much more satisfied with that approach. And we hired scientists and so on to build these systems and improve them. When I started doing trading, I got a little tired of mathematics. I was in my late 30s. I had a little money. I started trading, and it went very well. I made quite a lot of money with pure luck. I mean, I think it was pure luck. It certainly wasn't mathematical modeling. And so that's what we did. And gradually, these models got better and better and better and better. Yes, we were very successful, continue to be. As I say, there are others, but very few investment operations are 100%, because this is 100% model driven. It's not 90% or 80%. Some people have models and for advice. They say, oh, what does the model say? Oh yeah, let's go. Oh, I don't forget that. I don't want to pay attention to that. So, Renaissance is 100% model driven. No trade is ever made because someone walks into the trading room and says, hey, let's buy IBM, it's a sure winner, or anything like that. We got too much Google, we got a short, nobody does that. It may be that we had too much Google, but nonetheless, he might have been right. But it's just what the model says. And that religious sticking to the model is the only way you can run such a business, because you cannot simulate that guy who walked in and said, hey, Google's too high, let's sell it. How can you simulate that? You don't know what might have happened. But you can simulate you can come up with a model or a new predictor, and you can simulate it in the past and see, how did it do? So you have to stick to it.